soon as it gets to be 10:30.
Start right away. Hey everybody, my name's Amanda Bangs. I'm one of the co-presidents of the Social Enterprise Association. Just wanted to let you guys know about a really cool event we have coming up this Thursday that we're co-hosting with the Center for Sustainable Business. We're going to be hosting the CEO of M&T Bank, Robert Wilmers. It should be a really interesting event. He's going to be talking about how the bank has incorporated sustainability and social impact into their business planning and strategy. So definitely come join us. It's going to be right after the keynote speaker for Ally Week. It's going to be 6:15 to 7:30 p.m. Tish 411, and we will have refreshments. So check it out on campus groups and be sure to register. Thank you.
Thank you. Can't win in this building. I dress up for 75-degree weather outside. Air conditioning must be blasting in here. I mean, there's no way this room is this cold without the air. Oh well, that's a venting I've got to do with somebody else. Okay, so I promised you a spreadsheet that will let you get caught up. I thought about sending it last week, but I thought it'd be better to wait until after today's session because today we're actually going to talk about using that spreadsheet. So after class today, in the email that comes with the after class, you will get that spreadsheet. So let me start off on something I left you with last Wednesday. I was talking about how to use the cost of capital to find the right mix of debt and equity for the company. And it's not rocket science. What you try to do is find the mix of debt and equity at which your cost of capital is minimized. And the argument is when you minimize your cost of capital, holding your cash flows fixed, your firm value is maximized. So it becomes your optimal debt ratio. So I'm going to show you an example that is 38 years old almost to get this process started. This is actually the table I was shown in my first corporate finance class on how to optimize capital structure. And I have to tell you before I even go through the example that we were not happy with the example. So I'm going to start with it because it's where I started getting curious about the capital structure question. So the instructor walked in and he said, today we're going to talk about the optimal debt ratio for a company. XYZ widget company. I don't know why we invent widgets when we have real companies around. But I guess nobody's ever seen a widget. You don't know whether it's discretionary, non-discretionary. I can make up whatever beta I want and you can't contest me. And he put up the table to illustrate the process. He said, and essentially he said, we want to minimize the cost of capital. Let me show you how the process will work. In the first column, he had debt ratios from 0 to 100%. There's already a small problem you have there. Your debt ratio can never be 100%. And here's why. What's the definition of equity? It's a residual claim. Somebody's got to be willing to bear the rest of the risk for a business to operate, but that we were willing to cut him some slack on. Think of it as 99% debt, 0 to 99%. In the second column, he said, we're going to talk about the cost of equity for the company, and as the debt ratio for this company goes up, its equity will become riskier. And he told us a pretty good story. He said, as you borrow more money, your equity earnings become more volatile, therefore your cost of equity should go up. Guy in the front row, wasn't me, puts up his hand and he says, but why is it going up the way it is? Because if you look at the cost of equity, it goes from 10.5 to 11. And then 11 to, it goes up by 0.5% and 0.6%. And basically, it looked like he'd made up the numbers. He said, don't worry about the numbers, just get the concept, let's move on. And he moved on. He said, as you borrow more money, your cost of debt will go up. Why? Because a banker lending money to you is going to see more risk and demand a higher cost. Again, same guy in the front row puts up his hand and said, but why is it going up the way it is? And the instructor said, don't worry about it, it's only the concept that matters, let's move on. And he kept moving on. He came up with an after-tax cost of debt. He took the weighted average of the cost of equity and the cost of debt. Remember what we said last session. both the cost of equity and the cost of debt can go up, but your cost of capital can still go down because you're replacing more expensive equity with cheaper debt, and the cost of capital does go down initially. And in fact, at 40%, it is minimized to 10.14%, and then the trade-off starts cutting against you. So the instructor, this was the climactic moment. He said the optimal debt ratio for this company is 40% because that's where the cost of capital is minimized. He fleshed it out more and said, well, the cost of capital is minimized. If you keep the cash flows fixed at 200 million, growing at 3%, and you lower the discount rate, the value in the last column will be maximized at 10.14%. We weren't happy, and he didn't realize what we weren't getting. He said, this is obvious, right? But think about it. When you walk into a company, or take the company you've supposedly been working on for the last 9 weeks, or take the company I've been working on for the 9 weeks in class. Do I have this entire table for the company? No? We don't have. If we had a schedule this complete, anybody could compute the optimal debt ratio for a company. All you'd have to do is look down the second column, lowest number, you're done. We gave him such a hard time, he decided that we were just dim. And he said, okay, let me show it to you in a different way. And he put it down as a graph. He said, the cost of capital is this purple line. See where it's minimized. That is the optimal debt ratio for the company. He was missing the point, because what we were trying to say is, in a real company, we don't have the whole graph, we have a point. In fact, for Disney, the only point I have is the existing debt ratio and the existing cost of capital. I don't have a nice U-shaped graph. And until you get the rest of the graph, this is purely academic. You can't even come up with the optimal debt ratio for the company. I remember coming out of that class saying, there has to be a way to do this. I didn't know how to get there, but I said, there has to be a way. It took me about 7 years to figure out that way. But I'm going to take you through the process of how to take a company like Disney or any other company and flesh out the rest of the graph. Because if you can get a schedule that looks just like that schedule you saw for XYZ widget company, you should be able to tell me what the optimal debt ratio for a company is. Now, before I get ambitious, though, let me nail down the one point I do know for Disney. This is actually a page you've seen already in a different context. When I talked about the cost of capital for Disney as a company, this was our hurdle rate. But let me revisit that page because it tells me the one point I do know. Disney right now is about 84% equity, 16% debt. At its existing debt ratio, I know what its cost of equity is. The way I know it is I did that the bottom-up beta for Disney, given the 5 businesses it was in, came up with a levered beta reflecting its debt-to-equity ratio, its current debt-to-equity ratio, and came up with a cost of equity of 8.52%. Embedded in that equation are the judgments I made about what currency to use. I used a dollar risk-free rate, and an equity risk premium that reflects where Disney does business. That's my existing cost of equity. Then I went to the cost of debt, and you remember I got the cost of debt for Disney by looking at its actual rating. It was a single A rated company. I looked up the default spread based on that rating, which was 1%, added that on to my risk-free rate to come up with a cost of debt of 3.75%, and took the tax effect out of it. My after-tax cost of debt was 2.4%. Took the weighted average of those two numbers. My cost of capital at the existing debt ratio is 7.81%. So let me frame the question I'm going to try to answer. I know that the existing cost of capital for Disney at its existing debt ratio is 7.81%. In this part of the process, here's the question I'd like to ask. Is there a different mix of debt and equity for Disney at which its cost of capital could be lower than 7.81%? And don't be too quick to jump and say, of course, we don't know until we look because everything's going to change. That's the question I'd like to answer. And to answer that question, I need to flesh out the rest of the table. So what are the two numbers I need for my cost of capital? I need a cost of equity and I need an after-tax cost of debt. I need that at every debt ratio from 0% to 90%. So let me lay out how I'm going to try to do this. And as we go through this process, you're going to see why I've actually approached the way I estimate things the way I have all through so far. Let's start with the cost of equity. Under the cost of equity, the existing debt ratio is 8.52%. I know the beta, the existing debt ratio is but 1. If I change my debt ratio, can I figure out what my beta will be? And after 2 quizzes and levered and unlevered betas, we know how to do this, right? You unlever the beta, re-lever it back up. I can tell you what the beta will be at 10% debt, 20% debt, 30% debt. Now you see why I did not go with the regression beta, because if all you can do is use a regression beta, you're kind of stuck. There's nothing you can do when you change the debt ratio because you have still one regression beta. But because we started with an unlevered beta and worked up, I can tell you what the beta will be at every debt ratio. My risk-free rate obviously doesn't change. Will my equity risk premium change? No, it's the same company, same operations. So my risk-free rate and risk premium will stay the same. All that I have to do is re-estimate my beta. I will have a cost of equity at every debt ratio. So that's going to be easy. Let's turn to the cost of debt. The way I got a cost of debt for Disney is by looking at the actual ratings. The first time I did this, I actually tried something. I had a student who worked at S&P. And I emailed him a schedule with the debt ratios from 0 to 90%, say, could you email me back the ratings you would give Disney, or whatever the company was, at every debt ratio from 0 to 90%? Because if he'd emailed back saying, this is what the rating would be, it made my job a lot easier. And here's what he said, do it and then we'll tell you. Rating agencies are not going to telegraph what the rating will be at different debt ratios, hypothetical debt ratios. So I can't use actual ratings. So what am I going to do to get a cost of debt at 30% debt, 40% debt, 50% debt, 80% debt? What did I do for companies which did not have a rating? I used a synthetic rating. What was the synthetic rating based on? Operating income divided by interest expense, right? So here's what I'm going to do at every debt ratio. I'm going to compute what your interest expense is going to be, and not surprisingly, as you borrow more, your interest expense is going to go up. As your interest expense goes up, my interest coverage ratio is going to go down. As your coverage ratio goes down, I'm going to go to that lookup table and tell you what the rating is going to be at every debt ratio. So I'm going to have a cost of equity based on the levered beta, cost of debt based on the synthetic rating. Once I'm done with that, I'm actually going to get a schedule that looks exactly like XYZ widget company and take a weighted average and say, this is my optimal mix of debt and equity for Disney. And I'm going to close the cycle by saying, if I go to that optimal, here's what the value of Disney will be at the optimal. I'll tie up my loose ends and I'm done. So let's get the show on the road. Let's start off by first getting the numbers I will need as raw data to kind of get the process started. First, to do all those betas at different debt ratios, I need an unlevered beta for Disney. Luckily, I have those already because that's how I got the existing beta. There are 2 ways you can get an unlevered beta. One is if you just have the levered beta, you can get to the unlevered beta by. But for me, I actually had the raw data because I had the 5 businesses they were in. This was the table we used to come up with the unlevered beta. And the unlevered beta for Disney's operating assets was 0.9239. So weighted average of the 5 businesses they were in. That is going to be the number from which I'm going to get every levered beta at every debt ratio. So that's the first piece of raw data I need before I get this process started. The second is to get the interest coverage ratio. What's in the numerator? I need operating income. So I need to get a sense of how much operating income Disney has. So I checked that number out and I did all the cleaning up that I talked about earlier. I capitalized leases and treated them as debt. And my EBIT adjusted for leases for Disney in the most recent fiscal year was 10.03 billion, up from about 8.9 billion in the previous year. That 10.032 billion that you see in the second to last row is going to be the number on which I'm going to base my interest coverage ratio. Now already you can see that's a little dangerous, right? I'm taking 1 year's operating income and making that the basis for my interest coverage ratio. You're saying, what's wrong with that? Well, last year was a really good year. I might be overstating my ratings. Last year was a really bad year. I might be understating my ratings. The solution is actually common sense. If you have a company whose earnings are going up and down. In fact, somebody emailed me before the class doing Hudson Bay. They're in the class? Okay. Doing Hudson Bay, and what was the problem you were running into that was leading to some potential heartache? And they had a loss last year. Didn't you say that they had a loss last year? They have a loss last year. And if I put an operating loss in the numerator, I'm already kind of sunk, right? Because my interest coverage ratio is going to become a negative number. When I go to the lookup table, I'm going to give you a D rating no matter what you do. Your optimal debt ratio is going to be 0%. You say, what the hell do I do now? If those losses are the way things are going to be, that is actually the right conclusion to draw. That's why if you ask me how much money can Snap borrow, what's its optimal debt ratio, I don't have to run it through a spreadsheet. your optimal debt ratio is going to be 0%. That's where your cost of capital is going to be minimized. Now, Hudson Bay has potential advantage, which is they have lost last year, but they had profits in previous year. So at this stage in the process, rather than using the loss to come up with your interest coverage ratio, you might say, I had a bad year last year, but I'm probably going to bounce back. It might be hope that's driving that. You could take an average operating income over the last 5 years. So when I say this part of the process, for some of you, it might mean looking not just at the most recent year, but at the most recent 4 or 5 years, because that number, the operating income that you end up using, will drive how much you can afford to borrow. So we have the raw data done. Let's get the easy half of the equation done first. I'm going to try to compute the beta for Disney at every debt ratio from 0 to 90%, right? My unlevered beta is 0.9239. You saw where that came from by looking at the 5 businesses they were in. I changed the debt ratio to 10%, 20%, 30%, 40%. This is just a standard levered beta equation. No surprises. As my debt ratio goes up from 0 to 90%, my levered beta goes from 0.92 to 6.24. Why 6.24? Because at 90% debt, my equity is incredibly risky. It's a residual claim on a business with a huge amount of debt. That's a leverage buyout scenario of Disney. In the last column, you see my cost of equity. Again, no surprises. As my beta increases, my cost of equity goes up. So let me ask you a question. If my objective in capital structure is to minimize my cost of equity, what's the optimal debt ratio for me? If I want to minimize my cost of equity, I'm never going to borrow money. That's why you never frame your optimal as minimizing the cost of equity, because there's no point going anywhere else then. Your optimal debt ratio will be 0%. But if I look at it from the perspective of an equity investment in the company, my cost of equity will go from 8%, 8.07% when I have no debt, all the way up to about 38.69% at a 90% debt ratio. We now have 2 costs of capital, right? We know the existing cost of capital is 7.81%. What's the second cost of capital we now know? 8.07% is going to be my cost of capital at a 0% debt ratio. If you do Snapchat, you can stop right here, because you're going to find a 0% debt ratio is going to give you the lowest cost of capital, and you're going to see this play out with every one of my companies. So in this case, I have an 8.07% cost of capital at a 0% debt and a 7.81 at about a 14% debt ratio or 12% debt ratio. Now comes the messier part. It's not the more difficult, but it's a little messy. I'm going to take you through how I estimated the cost of debt for Disney at a 10% debt ratio by hand. You're saying as opposed to what? The Excel spreadsheet I'm going to send you after class will do this automatically for you, but don't make it a black box. You can actually replicate everything in that spreadsheet by hand. Because I started that by doing it by hand and then converting it to a spreadsheet. I'm going to try to estimate what the rating and the cost of debt will be for Disney at a 10% debt ratio. In order to do this, the first step is I need to figure out what the value of the entire business is. Not just Disney's equity, but the value of Disney as a business. So I took the market value of equity at the time that I did this, which is $121.9 billion for Disney, added the market value of debt. I know you don't remember where that came from, but that's the interest-bearing debt in market value terms plus the present value of leases. You add those two numbers up, the value that I get for Disney as a company is $137.8 billion. Right now, before I do any of the mechanics of changing the debt ratio. Why do you need to know that? At a 10% debt ratio, here's the first question I need to answer. How much dollar debt would I need to get to a 10% debt ratio? Now, do you see why I had to compute the value of the firm? $137.8 billion is the value of the entire firm right now. If I have only 10% debt, 10% of $137.8 billion will give me $13,789 million as the dollar debt at a 10% debt ratio. That's the first step. Then I go to the EBITDA, the DA, and the EBIT. Notice they stay exactly the same as if I had no debt. You say, how can that be? How can you be borrowing $13.78 billion and nothing's happening to your operating income? Because usually when you borrow money, you take projects with it, in those projects. You know what I have to do when I'm looking at capital structure? I have to do what's called a recapitalization. I have to hold the company constant, and when I borrow money, That comes in through one window, it's got to leave through another window. It's got to be, it cannot be investment projects, because if it is, it changes the characteristics of the company. So whatever I borrow here has to leave the company. In what form? I either have to buy back stock or pay dividends. So that's why it's called a so think of it in a balance sheet format. You have the assets of the company on one side, you have debt and equity on the other side. All I'm doing is changing the mix of debt and equity and isolating that effect so I can see what is the effect it has on my value as a business. So my first stop was 13,784. My EBITDA, depreciation, and EBIT look exactly like they did when I had no debt. And now comes the first tricky part. I need to estimate how much I will have as interest expenses at the 10% debt ratio. That's why I needed the dollar debt. So to get the interest expense, what do I need to do? I need to multiply the dollar debt by an interest rate. And there is a little problem I'm going to have to overcome that I'm not going to mention right now, but after I've described the process, I'm going to come back and ask you what that problem is. So I multiply the dollar debt by the interest expense. I come up with a $434 million interest expense. I'm almost home. I divide the 10,032 by 434 million. My interest coverage ratio is about 23. I go to the next page, look for 23. This is a large market cap page. 23 interest coverage ratio is a AAA rating with a 3.15% cost of debt. I come back and give them a AAA rating and a 3.15% cost of debt. I'm going to go through the sequence. You tell me where the problem in the sequence is. I start with the dollar debt, 13,789 million. I multiply the dollar debt by the interest rate to get an interest expense of 434 million. I divide the operating income by that interest expense to come up with an interest coverage ratio of over 23. I use the interest coverage ratio to come up with a rating of AAA, and I use the rating to come up with an interest rate of 3.15%. Where's the problem in that process? Yes? And what part of it is circular? What step did I run into that circularity? In step 2, when I had to get the interest expense, what did I do? I multiplied the dollar debt by the interest rate, right? The only problem is, if you're doing this by hand, you don't have an interest rate. And I used that interest expense to come up with the coverage ratio with an interest rate. I'll show you how I dealt with it manually when I first had to deal with the problem. And then I'm going to tell you that on the Excel spreadsheet, when you open it, some of you will get a circular reasoning warning from Excel. This is a feature, not a bug. In fact, what you have to make sure when you run that spreadsheet I send you after class today is to go into the calculation option in Excel, and there's a box called the iteration box. You've got to put a check on that box, because what it's going to allow the spreadsheet to do is go through the circular reasoning and work it out for itself. And you're going to see what I mean when I actually take you through the manual process of how to work it out. So that is my cost of debt. So let me take you to a debt ratio where I did have to go through the circular reasoning. Because here I got lucky. You know why I got lucky? Because it turned out that the rating I had at a 10% debt ratio matched up magically to the rating I'd have if I went through the circular process. So I'm going to ask for your help. And if you have a calculator, great. If you don't have a calculator, you can just go along with me. We're going to try to compute what the rating and the cost of debt will be for Disney at a 30% debt ratio. So the 20%, assume that I've already done the 20%. At 20%, I still had a AAA rating, and I still had an interest rate of 3.15%. So I'm going to get to the 30%, and we're going to try to work through by hand this circular process. So let's start at the top. A 30% debt ratio translates into a debt to equity of what? How do I convert a debt ratio into debt to equity? What do I need to do? If I have 30% debt, I have 70% equity, right? Debt to equity is 30 divided by 70. You're saying, why do I care? Because for the levered beta, you need a debt to equity. So you better be able to go between the two ratios, otherwise you're going to get stuck. So the debt to equity ratio is about 42%. Let's keep it rounded at that number. Okay? So that's 30 divided by 70. Now comes the first tricky number. How much dollar debt will I need to get to a 30% debt ratio? How much was the first 10%? 13,768 million, right? So basically every time I add another 10%, I have to add another 13,768. Somebody with a calculator, if they can help me out, this will be great. Add 13,000, what is it, 13,784 to 27,568. 41,352, great. So 41,352, did everybody get what I did? I just added the extra installment of debt, 41,352 million.
Can you explain that step a little more, why we're deriving our dollar debt like that?
Because basically what we're doing is when we did that first step of adding debt to equity, we acted like we know what the balance sheet is today, right? If you think about the financial balance sheet today, I know the market value of equity, I know the market value of debt. If I add those two numbers, that should give me the market value not just of the liability side, but also of the asset side.
Okay.
So right now, the market value of my assets is 137.8 billion.
Okay.
So when I go to 10% debt, it has to be 10% of those assets. When I have 20% debt, so basically at every debt ratio, I'm taking the asset amount and saying, what would 20, 30, 40% of that total amount be as dollar debt?
I see.
Yeah? And the reason we're able to do that is whatever we borrow leaves as equity, because otherwise we'll be changing the size of the balance sheet, and we're trying to avoid doing that.
I see. Okay.
So 41,352 million. Everybody with me so far? Now comes three really easy numbers. What are the next three numbers going to be? EBITDA, depreciation, and EBIT. They're going to be exactly what they were at 20% debt. Why? Because I'm doing this recapitalization. So you can copy down 12,517, 2,485, and 10,032 as EBITDA, DA, and EBIT. Now do you see what I mean about, if you're doing this by hand, how you get stuck? Because now I ask you, what's the interest expense? And what's the problem you have? You look below to get to the interest rate, and there's nothing there. Now, if you have to get started, I mean, you have to get started somewhere. What's the most logical number to get started with? You knew what the interest rate was at 10% debt, right? You know it's not reasonable to assume it's going to be the same. But let's get started as if the interest rate was still 3.15%. 3.15% of the new debt, I know it's tough to do because there's no numbers up there, of 41,352 should give you 1,302 million as your interest expense. And you can check my numbers if you want. So basically it'll be, so far you see it's completely unrealistic. I'm keeping the interest rate fixed, but let's act like you could pull it off. You've got a really stupid banker who says, that was the rate of the last 10%, we'll continue to lend at that rate. My interest expense is now 1,302 million. You divide 10,032 by 1,302 million. Somebody with a calculator needs to help me there. 10,032 divided by 1,302 million. 7.7. So what do I do next? I go back to the previous page and I look up that lookup table. I'm looking for 7.7. Where does that put me? It puts me at a AA rating and a cost of debt of 3.45%, right? So I put that, I put in AA and a 3.45%, we have a problem. You see what the problem is? To compute the interest expense, I used a 3.15% rate, and now I'm turning around saying, oh, sorry, it should really be a 3.45% rate, but I can do something about it, right? So what should I do? There's a second column here. I recompute my interest expense using the 3.45% rate, and I get 1,368 million as my interest expense. So basically, is everybody clear on what I'm doing? So I'm starting with the previous level's interest rate to get the interest expense. I'm recomputing now using my new interest rate. I come up with 1,368 million. You divide 10,032 by 1,368, you end up with an interest coverage ratio of around 7.3. And then I very gingerly turn to the previous page, hoping and praying what hasn't happened. That I could have slid in. I'll give you the good news. I've never slid more than 2 notches when I've done this manually. The bad news is sometimes you will slide 2 notches, which means you need a third iteration box. You know what Excel is set up to do in the iteration boxes? It does 1,000 iterations. Overkill. I've never had to go more than 3. It doesn't seem to cost Excel any time, but that's all Excel is doing is what we did manually. It does 1,000 times, it spins around. And what you end up with then is, is a rating of AA and a 3.45% interest rate at a 30% debt ratio. If you found that too messy, here's what I suggest you do. After class, try the 40%. I mean, we've already set the table, so do the 40% by hand. See if you end up with a rating of single A, which is what I ended up. So these are the final iteration ratings at each debt ratio. So as my debt ratio goes up from 0 to 90%, my dollar debt always increases proportionately because of the way I've set it up. It's $13,784 at each step. As my dollar debt goes up, my interest expense goes up more than proportionately. Why? Because as my dollar debt increases, my interest rate tends to go up, so my interest expense starts to climb more than proportionately. As my interest expense climbs, my interest coverage ratio plummets. As my interest coverage ratio plummets, I have ratings that start at AAA and end up at single C. I make Disney into a 90% debt ratio company. Its rating is going to drop to single C. Its interest rate is going to climb because at a single C rating, the default spreads are huge. There's one final loose end I want to make sure I tie up. Is this gives me a pre-tax cost of debt, right? But to get from a pre-tax cost of debt, I need to multiply by 1 minus the tax rate. And at least initially, I use the 36.1% tax rate I've used so far. But once I get to about 70% debt, something magical seems to happen. My tax rate, which was 36.1%, starts to drop to 32%, and then 27%, and down to 22%. So my first question is this good news or bad news for you when you're doing cost of capital to see a lower tax rate? It's bad news. Why? Because it makes you... So why am I taking away your tax advantages when you get to 70, 80, and 90% debt?
Because the interest expense is more than your income.
And so what? What happens then?
So you're essentially you aren't even covering enough, so your tax rate will automatically reduce.
If the government mailed me a check for 36.1% of my interest expense, no matter what, I can continue. But the way this works is I don't get a check from the government. I get to save on taxes only if I have income to cover that. Now do you see why if I took Hudson Bay and I put an operating loss as my starting point, you know what my tax rate is going to be starting at even at 10%? My tax rate is going to be 0 because if you're already losing money, what tax benefits are you going to get from adding interest expenses to the mix? So you're at 70, 80, and 90%, I lose tax benefits. So I want to focus in on exactly how I come up with that lower tax rate. It's actually very simple. Here's what I do. I take my operating income, which is $10,032 million. That's the most I'm going to be able to deduct, right? Basically, once I hit 10,032, I'm done. I compute my tax savings at the 10,032. I've hit my cap. If your interest expense exceeds that cap, guess what? I'm not going to be able to get more tax benefits. So at the 70% debt ratio, my interest expense is $11.1 billion. My tax savings is stuck at $3.622 billion. So when my interest expense climbs, effectively I'm ending up with a lower tax benefit on my debt. Now do you see why at 80% it goes down even further? At 80% my interest expense goes to $14 billion. I still have the same $3.6 billion in tax savings. So as my interest expense keeps climbing, my tax savings are capped. My tax rate starts to decrease. And when my tax rate decreases, in the last column you see my after-tax cost of debt climb, now because I'm losing tax benefits at the highest debt ratios. So let me summarize why the cost of debt will change as your debt ratio changes. The first and most obvious reason is as I borrow more money, my rating drops, my default spread increases, my cost of debt rises. The second is at very high debt ratios, if I don't have the income to cover the interest expenses, I get a double whammy. Not only am I paying a higher interest rate, I'm not getting the tax savings on that higher interest rate. It pushes up my cost of debt even further. I have a cost of equity from the levered beta. I have a cost of debt from my synthetic ratings process and this tax rate that I've computed. Let me bring them together into a table. This is the table, that XYZ widget company table that you saw at the start. This is my Disney version of the table. But on this table, if you point it to a number and say, why is that number what it is? I should be able to tell you why it is what it is. In fact, in the third column, you see my cost of equity. Why is it rising? Because at higher and higher debt ratios, I'm giving you a higher levered beta and a higher cost of equity. My cost of debt after taxes rises, again, because I have a synthetic rating that drops through the floor as you borrow more money. And the tax benefits are starting to get lost at 70, 80, 90% debt. The cost of capital is a weighted average of those two numbers. So what's the optimal debt ratio for Disney? What's my end game? What's my objective? To minimize my cost of capital, right? So let's go down. Initially, 10% is good, 20% is good, 30% is good, 40%, I'm at 7.16%, and then the worm turns. Notice how debt has now become, I mean, I describe debt as a double-edged sword. It can be great while it's you're chopping down other people, but then it turns on you, and at 40%, it's still in your favor, but somewhere between Also, notice that I've done this in 10% increments. I could actually set up this spreadsheet to give you the optimal debt ratio to the second decimal point, right? Because all you need to do is set up the spreadsheet to solve for the cost of capital, and it'll do it. Why am I not doing that? In the other class I teach is valuation, and I talk about the dangers of false precision, which is I could tell you the optimal debt ratio for Disney is 41.33%. Makes me feel good, makes me feel like I know more than I really do. But the reality is, what's this optimal based on? An unlevered beta, that is an estimate, an operating income, that's last year's operating income, a tax rate that could change any day. In fact, every single number in here is potentially a noisy number. I'd much rather tell you that your optimal is around 40% than tell you the optimal is 41.33, because at least then I'm conveying to you that this is an estimate, and if you end up at 37.56%, I'm not pushing you to go to 40, I'm saying you're close enough, just let it go. So that's part of the reason I've stayed with these 10% increments, but if you wanted to make it 1% increments, the spreadsheet actually is expandable, that you can make it 41%, 42%, actually get that precise number if that's your end game. So that's your optimal debt ratio. If you want to see it as a graph, nothing more you're going to learn, but there is actually an interesting feature to this graph that I started recognizing as I started drawing these graphs for real companies. When I took my corporate finance classes, in traditional corporate finance textbooks, the cost of capital is always a nice U-shaped curve. In my experience, that's almost never the case. This is more what I find with companies, which is there's a gradual decrease in your cost of capital as you go from the current debt ratio to the optimal. And then there is this inflection point where all hell breaks loose. Notice where that is? Between 40 and 50, you suddenly start climbing. This is not this, so basically what it says is, when you hit that inflection point, you're all of a sudden going to see your cost of capital increase. So what's the next implication of that? If you're going to make a mistake, which direction should you make the mistake in? Having too little debt or too much debt? You want to kind of undershoot rather than overshoot. It's a lesson that I think we need to keep in mind when we push companies towards borrowing more. Is you push them towards an inflection point, you could be putting their entire future at risk because a company could start blowing up on you. Okay. This is the 4th edition of the book you have, and in each edition I've looked at Disney's optimal. So I'm going to show you the picture I drew in '97. Same cost of capital graph. And incidentally, before I go there, notice the optimal for Disney was 40% here, which is a little unfortunate because it's the second example in a row that it was 40%, I think. Okay. The reason I say that is I remember a couple of years ago I was doing this session at an investment bank which will remain unnamed. It was a re-education camp where bankers were brought in, experienced bankers, and I was supposed to talk to them about corporate finance that they might have forgotten along the way. And there were quite a few bankers in there who did not want to be there. And one guy was absolutely open about the fact that he did not want to be there. He was in the last row, he put his feet up on the chair in front of him. He read the Wall Street Journal through 2 days. My only, the reason I didn't, he read this, he seemed to be reading the same page. He said, if you're going to act like you're reading the journal, at least turn the pages, act like you're reading. So I get to this session and this section, and he puts up his hand, he says, I have a question. So he says, I'm happy, finally he has a question. So I said, what's your question? He says, can we safely assume that the optimal debt ratio for all companies is 40%? I thought he was joking, but it's amazing how people have these rules of thumb on optimal debt ratio. Optimal should be about 30, right? For every company? No, it's not. So let's set that aside. You cannot safely assume that the optimal debt ratio for all companies is 40%. In fact, at the end of this class, I'm going to show you the optimals you're going to come up with for your companies. And you're going to find optimal debt ratios ranging from 0% for some companies And these aren't money-losing companies. These are just companies that don't make very much money relative to their value, to optimal debt ratios of 70, 80, even 90%. And we'll talk about why optimals vary across companies. But I'm going to take you back to my 1997 edition, where I did the same thing. I drew the graph, and there was one little problem with this graph. Notice what it is? It's not this, there's not a minimum and then you start rising. There was a kink. It's a kinky cost of capital graph. Okay. The spreadsheet I'm going to be sending you has been on my website in different versions for more than 20 years now. And I know people download it, they use it for all kinds of purposes, and I have no problems with it. But sometime in the late 90s, a group of bankers at the then, Bank One, which is a Chicago-based bank, started using this for their client presentation when they did optimals. And I learned about it, and I said, that's okay, it doesn't matter. So I'm coming back from a class one day, I come into my room, the phone rings, I pick it up, it's the first Chicago banker. He says, I'm calling from a restroom. These are the days before cell phones. I didn't know how he'd found a payphone in a restroom. He says, something very embarrassing has happened. I said, something very embarrassing has happened in a restroom? Call your mother, don't call me. He says, no, not that kind of embarrassing. I'm in the middle of a client presentation, and I've been using your spreadsheet, and I did the cost of capital graph for my client. There's a kink in the cost of capital. What's wrong with your spreadsheet? It takes a lot of gumption to download a spreadsheet for free, use it for commercial purposes, and then turn around and say, what's wrong with your spreadsheet? Okay. But I was feeling in a pretty good mood. I told him what was wrong with the spreadsheet, or why it was giving the kink. In fact, you could probably tell him why there's a kink in the cost of capital graph. It must be something in the process by which I'm estimating cost of capital at every debt ratio, right? In fact, I'll give you a second clue. It's got to be something discontinuous in the process. You know what I mean by discontinuous? A number that jumps and then doesn't jump and jumps. So what are the two numbers I use in my cost of capital? Cost of equity and a cost of debt, right? Is my cost of equity a continuous number? As my debt ratio changes, even by small amounts, my levered beta changes. So the cost of equity is not the problem. So almost by exclusion, it's got to be the cost of debt. How do I get my cost of debt? I take your interest expense, I come up with the coverage ratio, I go to the table, I look up in the table what your rating is. You see where the discontinuity is going to come in? So if I go from 20 to 30% debt, and I end up in the same line in the table, because remember your interest expense can rise but still be in that same row, I'm going to give you a AA rating at 20% debt and a AA rating at 30% debt, and I'm going to say your cost of debt is the same at both debt ratios. But that's even if I'm right on the rating, that's not true, right? Because if you look at the bond market, you can have two BBB rated bonds, but one BBB rated bond can actually have a lower interest rate than another because it's safer. But because I'm attaching one cost of debt to a rating, and that rating doesn't change until you jump from one line in the table to the next, your cost of debt doesn't change. So here's what happens. You can go from 50 to 60% debt, and I leave your rating at BBB. And then when I go from 60 to 70, the bottom falls out because now the rating double adjusts, and you go from BBB all the way down to single B. So I led him through the process and said, that's what's happening. He says, can I make it go away? I said, sure. There are two ways you can make it go away. One is this lookup table I have for ratings is my lookup table. I'm not constrained by how ratings agencies define ratings. If I make it AA++, AA++, in fact, if I break this ratings table, you can have 40 ratings. The problem will probably go away. He said, that sounds like too much work. I said, there's a second way you can do it. Why do I need a rating even in this process? To get to a default spread and a cost of debt, right? What if I could just connect my default spread directly to my interest coverage ratio? Do you see what I'm talking about? If I could make it like a levered beta, I could say, you tell me your interest coverage ratio, I'll tell you what the cost of debt is. You can make your cost of debt a continuous process. He said, that sounds too complicated. So then I asked him a question, where's your optimal debt ratio for your client? He said, about 20%. I said, where's the kink? At 60%. I said, what will happen once the kink goes away? What's your optimal? He said, it'll still be 20%. So I said, why do you care that there's a kink? Tell to your client, this is why there's a kink in the process. Unless you happen to have extraordinary circumstance where your kink happens at the optimal. then you have a problem. But if this is just cosmetic, I want a nice U-shape, you can make it go away. But why bother? So when you look at the cost of capital graph, that's basically where you're going. Any questions about the process by it? So the spreadsheet I'm going to send you will essentially do what I did for Disney essentially within the spreadsheet. It'll do the iteration. It'll look like magic. You'll get an entire cost of capital schedule. But my suggestion is take one column and see if you can work it through by hand by yourself, because it'll make you more comfortable with both the mechanics and make the spreadsheet less of a black box. So, yeah, go ahead.
In terms of some of, for example, the startups which they are losing money, but they have future tax benefits.
They have what?
Future tax benefits.
Well, wait until the future tax benefits show up before you take the debt. Don't borrow money in expectation of future tax, because there's no point. You see what I'm saying? If you're going to get future tax benefits, you can always switch from equity to debt. So wait for the tax benefits to show up. Don't borrow in advance, because not only might you not get the tax benefits, you might put your entire future at risk, because if you don't make an interest payment, what happens? The bank gets your startup. Why risk your growth assets, which are basically 99% of your value? Because the only reason for borrowing money, if you're a startup, is desperation. Right? If you're a startup, you don't have access to venture capital money, you want to grow, you have to invest, you're going to go to the bank and you're going to get down on your knees and you're going to borrow money. The bank is not lending on your assets. It says, look, put your personal assets up, put your parents' house to back it up. It's desperation time. If desperation drives you to borrow money, that's fine. But don't ask me if it's the optimal way you should be funding yourself, because clearly it is not. So if you're a startup losing money, wait till you have those tax benefits show up and then borrow the money. So now let's kind of set the table. We have an optimal debt ratio for Disney. It's about 40%. At about 40% debt, Disney will need to have about $55.1 billion in dollar debt. So basically, you look at the 40% line. Right now, they're at about $15.96 billion. So if my analysis is right, they have the capacity to go out and borrow $39 billion. But I'm telling them not just to borrow the money. What am I asking them to do with that borrowed money? At least what was the implicit assumption I was doing when I did this capital structure? They need to use that borrowed money to buy back stock. This is a massive transaction, right? And if the Disney board had any sense, they'd ask me 3 questions. The first question is, why should we do it? And you're saying that answer is obvious, because the cost of capital will be lower. You're going to see that's not a great sales pitch, that it's not going to convince too many people. Second question, if they have any sense, they should ask me is, what if something goes wrong? Like what? You have a recession. You have a crisis. How protected are we? And the third question they might ask is, Disney has all these great plans, right? Building the Shanghai theme park, expanding ESPN, shrinking ESPN, whatever they want to do. They have these plans that require capital, and it seems silly to borrow money and buy back stock and then go out and borrow money again or raise equity to build a new theme park. The third question they might ask is, what if instead of buying back stock or paying dividends, we actually took projects with the money? So I'm going to take those 3 questions, because those are 3 generic questions that always come up whenever you have too little debt. So let's start with the first question. Why should we do it? Let me start with the easier part of the answer. If you do it, your cost of capital, which right now is 7.81%, will go to 7.16%. You see why this is not very persuasive? What am I asking you to do? Borrow $39 billion and buy back stock, and if you do that, your cost of capital is going to drop by 65 basis points, right? You're going to say, you want me to do what? To get what? It seems completely disproportional. So I've got to take that 65 basis point drop in the cost of capital and make it real money. So here's the way I'm going to do it. I took the cash flows for Disney as a company right now. You know how we computed cash flow for a project? We took the after-tax operating income, you subtract out net capex and change in working capital. The cash flow for Disney as a company right now is about $3.657 billion. So that's our existing cash flow. We said the value of a firm is the present value, those free cash flows. Let's keep that present value equation really simple for the moment and assume that Disney is a mature company. If it's a mature company, remember I can assume that growing perpetuity model, where in the numerator I'm going to put in the $3.657 billion cash flow, and in the denominator I'm going to put their existing cost to capital of 7.81%, and on the left-hand side I'm going to take the existing value of the firm, which I know to be $133.9 billion. So what I have is the existing enterprise value for Disney, so the market value of equity plus debt minus cash. I have the cash flows, I have the cost of capital. It's one equation, one unknown. If I work long and hard enough, I should be able to convert that one unknown into a known. I solve for the growth rate. You think, where's this going? I thought we were in the capital structure section rather than the valuation section. I'm using the existing market value of the firm to back out the growth rate. If I then plug in the new cost of capital, keeping everything else fixed, I'll get a new value, because the only thing that should change after this capital structure change is my cost of capital goes from 7.81 to 7.16%. The value that I get for Disney with a 7.16% cost of capital instead of a 7.81% cost of capital is $172.9 billion. That sounds too good to be true. Going from 7.81 to 7.16 increases my value for Disney as a company by almost $39 billion. It is too good to be true, and I'll tell you what's wrong with that equation. I'm assuming a 4.94% growth, 4.84% growth forever. That's going to be impossible when risk-free rate is at 2.75%. So this equation works, and this process works if you have a nice mature company, which most of you will not, and you can back out the growth rate, plug back the new cost of capital, and come up with a change in value. So I'm going to give you a shortcut that will work for any kind of company, not just for mature, and will give you a more realistic answer. Here's what I did. I took the existing cost of capital of 7.81%. One way to think about the cost of capital is right now you're funding your entire operating assets at that cost of capital, and it's your annual cost. So right now the annual cost of funding Disney as a company is $133.9 billion times 7.81%, which is $10.458 billion. That's their existing cost. If they go to the 7.16% cost of capital by moving to their optimal, that cost will drop to $9.592 billion. You take the difference between those two numbers, you're going to save $866 million in 1 year. That doesn't sound like much, but remember, this is a permanent change in your capital structure. If you have a company that is going to continue to grow in the future, and here you can put in realistic constraints on the growth rate. I'm going to cap it at the risk-free rate. Savings of $866 million growing at 2.75% a year forever gives me a present value of almost $19.6 billion. By moving to my optimal, I'm going to increase my value as a business by about $19.6 billion. So if you ask me why should I do it, I'm never going to say 65 basis points. I'm going to say about $20 billion of your value. And you might say, I don't care. In which case, you tell your stockholders you don't care. But that is the effect of moving. And the reason I kind of emphasize that is with big companies, cost of capital will never change by 3, 4, or 5%. It's not going to happen. You're going to get a 0.5%, 1%. You think, that doesn't sound like a big deal. Put in the numbers and see how much it translates into in terms of value. And you will be surprised at how much of a big deal it is to lower your cost of capital by a 0.5% or 1%. So my value as a company, if I do this, will increase to $153 billion. So you're the board. I make this pitch to you. You might say, look, we're conservative, we don't go to borrow money. But let's say you decide that this sounds interesting, that you're willing to explore the next step. What's the next step? You'll have to go out and borrow $39 billion and buy back stock, right? Exactly how does that process work? How do you buy back $39 billion of your own stock as a company? There are two ways you can buy back stock. One is you can go what are called open market purchases, where you go to the market and you buy a little share now. With $39 billion, you're not allowed to do that because the SEC will say you're essentially holding back information that investors need to know. With a $39 billion buyback, the only way to do it is to do a tender offer. It's just like an acquisition. You take a full-page ad in the Wall Street Journal or whatever the online version of it is today, and you tell Disney stockholders to tender their shares back, and you offer a buyback price. This is a practical question you have to face here. If you're going to buy these shares back, the stock was actually trading at $67.71 before any of this process got initiated. You're not going to be able to buy the shares back at 67.71. Why? Because you could put a tender offer and say, I'm buying back shares at the existing market price. Who's going to tender to you? So you've got to pay a premium. And one of the big questions that companies should answer more carefully, and often don't when they do buybacks, it's what should that premium be? Let's see why, right? Let's assume that you're all Disney stockholders. In fact, this is the entire stockholder base for Disney. And I announced to you that I'm going to buy back shares of $39.5 billion. And let's say you've all worked out the numbers. It's kind of an extreme assumption. So you have a choice of either selling your shares back or not selling your shares back. It's voluntary, right? If you can offer your shares and get the cash, or you can hold on to the company. I'm going to first give you what I call my fair solution, a solution where you're indifferent between the two. And in the fair solution, here's what I'm going to do. I'm going to take the 19.6 billion increase in value and divide by the total number of shares outstanding. You see why total number? Because everybody then gets an equal share of that 19.6 billion. That works out to $10.90 per person. So here's what will happen. I'll offer in my buyback $78.61 as my buyback price. You can sell it back to me and take $78.61 in cash, or hold on to the shares, in which case your share price will rise to $78.61. That's why it's a fair price. I'm trying to keep things even here. If I were able to buy the shares back at much less than $78.61, let's say I was able to buy the shares back at, I'll come back to that. If I were able to buy the shares, let's say I was able to buy the shares back at the old price. Let's say there was a group of stockholders who were so desperate to get rid of their shares that, and let's say you're the ones who would sell your shares back. Let's say you sell back at $67.71. You see what's going to happen? I'm going to buy the shares back at $67.71. You're going to get the entire spoils, the 19.6 billion. But now instead of dividing by the total number of shares outstanding, I'm going to divide just by the remaining number of shares. And what I'm going to end up with is an $83.78 share price for you. And you got only $67.71. So if I pay 70, whatever that price was, $78.61, everybody gets an equal share. If I pay $67.71, you guys win and they lose. If I pay $85 in the buyback, tell me what's going to happen. They're going to end up with almost an 18% increase in their stock price, and you're going to end up with far less than. In fact, there is some price at which I could leave you worse off than you were if I pay $150 per share. I could actually end up driving your price below $67.71. Why? Because I've given away too much. Let's go think about the process of a buyback, and let's see what kind of mistake is more likely to happen. I'm an investment bank. You come to me and you want me to do the buyback, right? So I get to set the price. What makes my life easier? Setting a higher price or a lower price? What makes this process go smoother? I'm going to set a higher price because that means more people will tender. So if I'm making a mistake, I'm more likely to make the $85 mistake than the $71 mistake because of the way I look at my job and I say, I'm going to collect a 3% commission. What makes my job easier? That's why as a company, you can never turn over the buyback decision entirely to the banker. You have to work out what your break-even price is and say, that's the price at which we will stop. You're saying, what if I can't buy back shares? Pay a special dividend. There are different ways of returning cash. You don't have to buy back stock, but this process is what, basically you're transferring wealth from one group of stockholders to another. So the more general way of thinking about how this works out is if you give me a buyback price, I can actually compute the shares that will be outstanding after the buyback price. Then I'll figure out how much of the money of the 19.6 billion I paid you with the buyback price, and then I'll take whatever's left over and I'll figure out what your share price is. If I pay that fair price, then you're going to get that equal allocation of the 19.6 billion. But hardly ever do you see a fair price played. Usually if there's a group that loses, it's the loyal shareholders who choose not to sell their shares back. People tend to overpay on buybacks because it makes the process go smoother. Right? So why should we do it? It's 19.6 billion, and that 19.6 billion will translate into about a 15% jump in your stock price, even at a fair price. And if it's not a fair price, then we have to work out who gets a bigger chunk of the spoils. But that's why you see recapitalizations, that pushing the stock price up when you see recapitalization. There are about a couple of hundred recapitalizations that have happened in the US in the last 20 years. And usually it's predictable. There's a big recapitalization. The stock price will jump on a recapitalization. But it'll jump only if you're an underlevered company borrowing money to go to. So if you're already overlevered, if Valiant does a recapitalization by borrowing money and buying back shares, its stock price is not going to go up, it's going to collapse. So it's not the process of borrowing money and buying back shares that's pushing up the price. It's a process of moving from being underlevered to a more correctly levered position that's pushing up your value as a company. Okay. Any questions on that? So take a look at those pages. I know there are a lot of numbers that come in. Take a look at the mechanics, because those mechanics are what will drive what happens to your price after the buyback. And you can see at the 78.61, if I pay the 78.61, what you get as your increase in value and what you get as increase in value would be exactly the same. So try different prices. Try an $80 price, try an $84 price, try a $68 price. Yeah.
Both historically and logically, why would you do a big tender offer as opposed to a special dividend?
Why would you pay a big tender offer as opposed to, because if you feel your stock is overpriced, there are all kinds of other things that come in, right? So if you feel that let's say you think, if you feel your stock is overpriced, the buyback might make sense to you because you're buying back shares from some people in France. But let's say you believe your stock is undervalued, right? And you're doing a buyback, then you get a double whammy. So how you view your pricing of your stock will play a role. How the two get taxed will play a role. We're going to come back and talk about how at one point in time capital gains were taxed at a much lower rate than dividends in the US. Then there was a much bigger incentive to do buybacks as opposed to paying a special dividend. Now the tax rates have converged. And there are some parts of the world where the tax rate on dividends is actually lower than the tax rate on capital gains. So there are a number of issues that go into should you buy back stock or pay dividends. It's not always a slam dunk that buying back shares is always better for you. Yeah. Any other questions? Now let's talk about what if something goes wrong. If you ever have a client for whom you do an optimal debt ratio, and they ask, what if something goes wrong? The one answer you should never give is, nothing will go wrong. It's almost like the gods are waiting for you to say that, and the whole thing lands on your head. So whenever I'm asked, what if something goes wrong, I always turn the question back on the person asking the question. I say, what do you think? What are you worried about that might go wrong? And the answers you get will vary depending on the company. If it's a cyclical company, they're usually worried about an economic recession. If it's a defense contractor, you know what they're worried about? That one of their big contracts will disappear. If you're a supplier to Walmart and you get 60% of your revenues from Walmart, what you're worried about is, hey, what if they pull the contract? And once I know what they're worried about, then I can start asking the question, what happens if I build that into my numbers? What happens at optimal? My job is to not get you to borrow more money. It's to borrow more money only if it makes sense to you. And this part of the process, I have to bring in those constraints. So there are two ways I can do this. One is I can ask what if questions. And I'm going to show you the key number that drives the optimal is actually one number, that operating income number. Everything else is a side story. So you can ask, what if my operating income were 20% lower, 30% lower, 50% lower? The second is you can take the specific worry that the person has, a recession, a loss of a contract, build it into your numbers and say, this is what your optimal will look like if there's a recession. Maybe at the end of the process, they might decide not to borrow the money, but that's perfectly okay. The other way you can try to build in a buffer is when I told you that the optimal debt ratio was where your cost of capital was minimized. I never mentioned what rating you had at that optimal, right? What if your rating for Disney at 40% debt were double B or single B? You're saying, well, that's going to be a problem. So I'm going to bring in a rating constraint, how you might not want to drop below a rating into this process. So let's start with the first what if analysis. To decide what a bad year would look like for Disney, I actually looked at Disney's own history. You think, bad year, we know what a bad year looks like. Your operating income is going to drop. You're right. But how much will it drop? A bad year for a regulated utility like Con Ed is a 5% drop in operating income. A bad year for a technology company could be an 80% drop in operating income. So I'm just looking at history to see what do bad years look like for Disney. So this is about 25 years of data. And if you go through the 25 years, the worst year they've ever had in their history is 2000. In 2000, their operating income dropped by 29.5%. So I have a sense of what a really bad year for Disney looks like. In fact, if you look at the recessions over the last 50 years, the worst year they've had is 29.4. In 81, 82, their operating income actually increased in the midst of a recession. In 91, it dropped by about 22%. In 2002, it dropped by about 16%. And in 2009, dropped about 23%. I'm starting to get a sense of a bad year for Disney is about 25, maybe 30% drop in operating income. When you do this for your company, if you see minus 70, minus 60, minus 50 in the history, that might frame what you think is a bad year for your company. Okay? So the reason I look at history is not to get some mechanical equation, but to get a sense of how much should I be dropping the operating income by when I do my what-if analysis. So here's what I did. I took everything else in my spreadsheet, and that's the nice thing about having the spreadsheet do the dirty work for you, and I lowered just the operating income. Because the operating income is really the driver of my optimal debt ratio. It's how much earnings you have that drives what your optimal debt ratio is in the cost of capital approach. So here's what happened. When I dropped my EBIT by 10%, nothing happened to my optimal. 20%, nothing happened. 30%, nothing happened. In fact, I had to get about 35, 36, 38% drop in operating income before my optimal shifted. You're saying, so what? The worst year Disney's had in the last 25 years is a 29% drop in operating income. If you're a manager at Disney and you're at 12% debt, and I'm asking you to go to 40%, and you're conservative and say, what if something bad happens? What if we have a bad year? My comfort to you would be, even if you have the worst year you've had in the last 25, you're still okay. You know what would have changed my conclusion? Is if I dropped the operating income by 10% or 20%, my optimal went very quickly from 40 to 30 to 20. And that might happen for some of your companies, and that's got to be a factor in whether you push your company towards your optimal, is how much of a buffer you've built in this process. And Disney seems to have a significant buffer where they can borrow a lot more, maybe not 40, maybe they can get to 30, and not really be affected by having a bad year pushing them into default or into a really bad scenario. So that's one way to kind of deal with this what if something goes wrong, is take that operating income number, make that the vehicle for answering, hey, this is what could happen. Let's talk about bond ratings. Okay? When we talk about bond ratings, there's a rating. Almost every company you talk to will have a minimum rating below which they don't want to drop. In fact, in much of in the US or in Europe, what's that rating below which companies don't want to drop? What's that magical rating below? It's called investment grade, and you drop below investment grade, bad things happen to you, supposedly. What happens when you drop? First, investment grade is triple B. Right? That's the S&P, you drop below triple B. What's so bad about dropping below investment grade? Why do companies have such a fear of dropping below investment grade? First, bad news stories show up, right? Wall Street Journal drops below investment grade. Sam? In other words, your equity investment, there might be some, but really the bigger problem you face when you go out to borrow money, if you're below investment grade, your capital markets shrink. There are certain people who will not buy your bonds if you're below investment grade. It's much better than it used to be. 50 years ago, if you were below investment grade, forget about issuing bonds. Nobody would buy your bonds. That has changed, but you still have this problem of once you fall below investment grade, bad things happen in the capital market. In fact, the way I think about it, remember those indirect bankruptcy costs we talked about? Where when people perceive you're in trouble, you start spinning out of control. You drop below investment grade, you're in danger of entering that cycle. So I understand when companies say, we want to be at least investment grade, I think that's a reasonable constraint. In fact, if you say, I want to be at least single A because I want some buffer over investment grade, I can live with that. You know what I cannot live with? Companies that say, I want a AAA rating at any cost. I remember having a conversation with the CEO of a European steel company that at that time was the last AAA rated steel company in the world. So I asked him, what's this fixation? Everything the company did was driven by that desire to maintain the AAA rating. So I asked him, what is this fixation you have with the AAA rating? And he told me. He said, it allows us to borrow money at a really low rate. So I asked him, how do you keep your AAA rating? And he told me again. He said, we never borrow money. This is the kind of circular logic that gets us into trouble, right? If the only way you can maintain a AAA rating is by never borrowing money, what are you gaining by having a AAA rating other than walking around saying, I'm the last AAA rated company in the world? I'd much rather that you took a AA rating and actually borrowed money than keep a AAA rating and not borrow money. So if you're ever given a rating constraint by a company and they say at any cost, rise to the challenge, give them the bill. It's actually fairly easy to do. Because if you think about my optimal, the way I came up with the optimal is I look for the lowest cost of capital. I never even check the ratings. Now if you gave me a rating constraint, all I'm going to do is go into the same spreadsheet and look to see what the lowest cost of capital I can get given that rating constraint. I know it sounds incredibly abstract, but let's take Disney, right? The optimal debt ratio I came up unconstrained for Disney was 40%. And actually my synthetic rating was single A, which I think is fine. But let's say they came back and said, look, we want a AA rating. That's our constraint. I obviously can't go all the way to 40%. I have to stop at 30%. Remember in operations research, you have a constrained optimal. Your constrained optimal is never going to give you as high a value as your unconstrained optimal. At a 30% debt ratio, my value for Disney is lower because its cost of capital is higher. In fact, the cost of having a AA rating constraint is about 5.7 billion. So if you really insisted that you wanted a AA rating, I'd say, okay, this is how much it's going to cost you. Just let your stockholders know. If you want a AAA rating, it gets even more constrained. I have to stop at a 20% debt ratio. And at a 20% debt ratio, my value is 141 billion. That difference of 12 billion is the cost of a AAA rating. So if you want to put in a rating constraint in your company, it's easy to do so, but always cost out the constraint. The reason I cost it out is it's almost always a self-imposed constraint. Right? AAA, I mean, where did that come from? Why AA? And that constraint you've imposed on yourself is costing your stockholders money, and it's your job then to justify to them why you want to stay a AA rated company. There's nothing glorious about having a high bond rating just for the sake of having a high bond rating, if you can't really use it to lower your cost of capital. Which brings me to a third and final question. What if instead of doing this recapitalization, there are in fact some parts of the world where you can't buy back stock. You're not allowed to buy back stock as a company. Much of Europe, in fact, until about 10 years ago, you were incredibly constrained in buying back stock. What if you can't buy back stock? What if you're not allowed to pay a special dividend? And what if you have great projects? What if instead of borrowing the money you took great projects? Will the optimal be different? I'll give you the easy answer first. No, if you're going to stay in the same mix of businesses you're in. What am I talking about? If Disney is going to borrow money and build more theme parks, make more movies, expand broadcasting, I'm going to say the optimal stays at 40%. Why? Because I'm assuming the firm will scale up, that the operating income will scale up with the firm, the optimal debt ratio is going to stay the same. So if you're going to stay in the same business, expand your business, the optimal that we computed using that buyback assumption will actually carry over into your company and you can use it to take projects. Let me reframe the question. Let's suppose Disney looks at this analysis and says, we have an optimal debt ratio. We can borrow up to 39 billion. What if we took the 39 billion and bought Twitter? Do you think your optimal debt ratio might shift if they took the money and bought Twitter? Let's look at Twitter as a company. Risky company or safe company? Risky. Money-making company or money-losing company? Money-losing, right? So you're basically buying a risky, negative cash flow business and adding it to your existing business. What do you think is going to happen to your optimal debt ratio? Is it going to go down or go up? It's going to go up? No, it's going to go down because you'll have less operating income, more risk. So if you wanted to buy Twitter, here's what I'd need to do. I'd need to take Twitter's numbers, add it to your numbers, and come up with a new optimal debt ratio for your company, which is not going to be 40%. Your $39 billion excess debt capacity is very quickly going to dissipate away. But I can't give you a blank check saying you have excess debt capacity, go out and do whatever you want. I need to know what you plan to do with the money before I can say, okay, or that's not okay, depending on what your plans are. So let's review. Why should we do it? But $19.6 billion in increased value, increase in your stock price of anywhere from $11 to $15, depending on how you frame the buyback. What if something goes wrong? At least for Disney, it looks like they have enough buffer if something goes wrong. Their operating income can drop by 10, 20, or 30%, and they're okay. And their rating at their optimal is a single A, which is not a bad rating. What if we want to take projects instead of buying back stock? Not a problem, as long as those projects are an extra theme park, more movies, more broadcasting. Just go out, don't go out into a new business and not expect me to revisit the optimal. And that's the kind of question you will have to ask, because after the spreadsheet, you're going to get an optimal debt ratio for your company. Saying, that's it? I have an optimal. What do I do now? That's when your work starts, because you have to answer those 3 questions for your company. So let me close off today by doing the same analysis I did for Disney, for my other companies. And along the way, I'll talk about some of the issues I ran into with each company. Right? So basically, I took the same spreadsheet. I do exactly what I did for Disney: cost of equity, cost of debt, minimize the cost of capital. Let me start with Tata Motors. With Tata Motors, the optimal debt ratio I came up with for the company was about 20% debt. If you look at the second to last column, so the cost of capital is minimized. 20% debt. Their actual debt ratio was about 29%. So Disney was underlevered. They had too little debt. Tata Motors is overlevered, right? There's too much debt. Actually, with Tata Motors, here's what I followed up by doing. I looked at Tata Steel, Tata Chemicals, and Tata Consulting Services, 4 big Tata companies. And here's what I saw. Tata Motors, Tata Steel, and Tata Chemicals all were overlevered. They all had debt ratios about 10, 15, 20% above their optimal. Tata Consulting Services was massively underlevered. Now, this might be the cynical part of me working. But it looked to me, at least looking from the outside, that when Tata Motors goes to borrow money from a bank, what's the bank doing? It's lending money to Tata Motors, but it's assuming that the Tata Group will back up that loan. In other words, Tata Consulting Services is implicitly subsidizing the acquisition plan. So when Tata Steel bought Cora Steel, Tata Consulting Services shareholders bore some of that. They provided the subsidy. So if I'm a stockholder in Tata Consulting Services, I should be really pissed off, because that money belongs to me. I should be borrowing money and claiming the value, but instead what's happening? Tata Motors, Tata Steel, and Tata Chemicals are getting the benefits of my debt capacity. What can I do about it? Absolutely nothing. That's where corporate governance matters, right? But at least now we have some insight into why in family group companies you can find a company to be massively underlevered or massively overlevered. And before you decide they're insane, it might just be the group interest playing out in there. And that's what I see at Tata Motors. Then I took Vale. Okay. Vale, I did the optimal debt ratio. Their optimal debt ratio was about 30% debt. They were at 39%. And Vale's CFO actually was a student in this class about 20 years ago. So we went through, and he's actually he's one of the smartest CFOs in Brazil. So I pushed him on this. I said, look like you have too much debt. And this was in 2013, and he said, just wait for iron ore prices to come back. Because as an iron ore company, he said, our operating income is depressed right now because iron ore prices are down. That's why you're finding us over-levered. But if we replace today's operating income with an average over the last 3 years, or look at the average, then we're okay. In fact, if you replace today's operating income with an average across the last 5 years, which is higher iron ore prices, your optimal debt ratio looks like it's 50%. So we're not underlevered, we're not overlevered, we actually have debt capacity. But it's built on the presumption of what? That commodity prices will go back up. It's 4 years later, and iron ore prices have not gone back up. And this is not just true for iron ore. Across the commodity space in 2013, if you ask oil company CFOs, iron ore company CFOs, basically they all said, it's only a matter of time, we're going to bounce back up. So in 2013, many of these companies had looked at their debt capacity and they said, you know what, we look over-levered, but we're okay because prices will bounce back up. It's taken almost 4 years for that denial to go away. Now all of these companies recognize that they need to bring their debt ratios down. But you can see how there can be a lag between operating income dropping at a commodity company and it kind of recognizing that it's over-levered. Because it's human nature again. Oil prices go down to 40, they must go back to 75. They always do. So in this case, you can see me trying to normalize the income. But when you normalize income, you are implicitly making the assumption that last year was just an aberration. You're going to bounce back. And that's my advice on Hudson Bay is when you replace the operating loss with the average operating income over the last 5 years, what are you telling me about the future of Hudson Bay and retailing in general? That they're going to bounce back. And one of the big unknown questions in retailing is anybody ever going to bounce back? That maybe we're on this one-way street where essentially these companies, Staples is in trouble, Bed Bath & Beyond. I mean, you go down the list of retail firms, looks like many of them are just sliding away, and that is the question you have to confront, and you might decide that it's not really realistic for them to bounce back to some income from 2 years ago, 3 years ago, that they're in long-term trouble. Yes? When you do what? Why aren't you getting the same bump when you take a project? What you're saying is markets are irrational and inefficient. Maybe a buyback is a way in which you can exploit it. That's absolutely possible, right? And that's got nothing to do with value. It's got to do with the pricing game that you're paying. So there might be short-term, and that's actually one of the things that worries people about the buyback phenomenon we're going through is how much of this is driven by short-term taking advantage of markets where you're turning away good projects and doing buybacks that really don't make sense to you. Okay? That's it.
I know like you're talking about like very stable, but my question is like for like late stage startup companies, I say like for I guess Airbnb, like Uber, or I mean Snap, like before that
Yep.
like when they're raising like a much higher valuation, like what would you do if I have a DCF model to support valuation? What would you do like that?
Why is it any different? What do you mean? I'm not sure what you mean by what would you do.
So
You're in a scenario with high revenue growth and margins changing, right? So that's what you would do is you put the high revenue growth, then you've got to forecast out how you expect margins to change over time.
right, but so basically like for example like Flipkart,
Right.
and I have a model to support a fair valuation, and then we know like they have this new financing round. Maybe value
The financing rounds have no effect on the value. That's how they continue to go. So valuation is a function of your revenues and your margins. So you're valuing Flipkart or Airbnb or Uber, that's what you'd have to focus on, is where's the value coming from. Right?
Right. So I guess for like basically for fair value, and would you? I mean, if in this case there is a transaction on the market, would you?
The transaction doesn't affect value. Why would it affect value?
But isn't it a price?
It's a pricing. So what? So there's a pricing you get from the transaction, but are you valuing the company or are you looking for a pricing for the company?
So, but I mean, I guess when you're doing, like some sort of reporting, financial reporting, say
You
like,
report the pricing. Basically, you get a pricing. Anytime a venture capitalist invests in a company, you're getting a sense of what they price the company at. So when the Saudi sovereign fund invests in Uber, it priced the company at 61 billion. So you report that it priced the company at 61
so
billion.
we think that's the fair value. I mean,
No, it's
if
good.
we're
It's got a fair price.
fair, okay. So fair price and fair value.
That's two different. Value is based on cash flows, growth, and risk. It's based on the business you're building. Price is based on what people will pay for it.
So, interesting. But I mean, you say like all the mutual funds that they hold private companies.
They
and
price
then
them. They don't value it. They don't care about value. They care about pricing. Mutual funds don't play the value game. They play the pricing game.
Right, but they also their price would fluctuate. Like,
Which is true for any investment, right? Why is that true for just Uber?
well, if they only take the transaction price as the fair price, and
But then next time there's a transaction, they have to reprice it.
I guess the price line you will see like all of a sudden like jump to the next level, but you also see them like fair value.
You're assuming that transaction pricing is set based only on So what if there's a transaction in Lyft?
Right.
It'll affect because pricing basically look to see what people are willing to pay in the market for companies in that same space. So you don't need another transaction on Uber to reprice Uber. If Lyft in its next round is priced at 50% above its last pricing, when I price Uber, I've got to take the 61 billion and adjust it up for the fact. So pricing changes all the time because there are other, it's like when you price your house, right? Let's say a house in your neighborhood sells for 20% more than you thought it would.
But is it really applicable to say,
It's the only thing that matters. In pricing, that's all you care about, is what are people willing to pay.
but is it, like for some part of the company say, it's really, it has some risk in terms of financing, they couldn't get
Doesn't
enough.
matter, right? It's all in the price.
Okay.
It's all in the pricing. So when you say there's no risk of getting transactions, so what does that mean?
Yeah.
It's all in the pricing. It's a pricing game. VC, I mean, go check on my blog. I have an article on why VCs play the pricing game. They don't play the value game. Because it's all about pricing. Because you buy at low price, you sell at a higher
So
price.
do you think it's like good to
It's
put
markets,
a
it's-
DCF model to support
You
those?
know, I don't know whether it matters to you. If you're playing the pricing game, why waste your time?